Hello everyone and welcome to this new episode of Stock Analysis. Today we're going to be talking about Matterport, trading under the ticker symbol MTTR. So let's begin by first talking about its initial appeals. In my opinion, the initial appeal, or in other words, the reason why we first heard about this stock was because its price took off. Or rather, instead of saying that its price took off, I want to say that things started well. Because it first began trading back in 2021 when the stock market was in a bullish phase. And speaking of bullish phase, I want to say that it's actually like the most spectacular end of the bullish phase, right? Because the bullish phase began over a decade ago and it just continued to run higher and higher and higher before the correction ultimately arrived. But it began trading before that, so people were under the impression that sky's the limit, which theoretically is true. For every single stock that we talk about, if you long the stock, the sky's the limit. If you short the stock, the potential profit is whatever the difference is between the current price and zero. That is also why I personally would never recommend to go short against the stock. Even if we put aside the ethical issues that are with it, that have or don't have, it's not really a good idea to assume that the stock will go to zero. Because if a stock deserves to be shorted, very often by the time this kind of news reaches the retail traders, it's already very low. So the downside is already limited. In other words, the short seller's upside is already limited, right? If on top of that, the assumptions were wrong, then we might get into trouble. So the current situation about MTTR or Matterport is very similar to other tech stocks or growth stocks. The stocks that went up a lot during the 2020 to 2022 period of time. Its price action, in my opinion, resembles highly the one of Palantir, Neo, Lucid, and even Nikola. So we might talk about Nikola in another episode, but essentially my point is the following. The market's perception is that these companies belong to the same category, and they deserve to be looked at. They deserve to be put on a short list. But is it really time to invest the capital in those companies now? They're not convinced. So they don't want to abandon those companies outright, but they don't want to invest in them just yet either. We're in a in-between that may last a couple months to a couple of years. A lot of people are saying that the current recession might last for at least 24 months. And other people are also saying that, we might be going for a decade with very low growth. But of course, we have heard that before, so I wouldn't really put this as something that's set into stones. So far, the price action has been challenging in 2022 because of the market sell-off. I don't think that a company itself deserves to be put on the side from its own fundamentals. And of course, the sector itself is relatively novel, but compared to other things, for example, compared to Palantir, what Matterport does is also relatively easy to understand. You get the point when you see what they propose on their website. So the demand remains to be seen, but we know for sure that the potential is there. Whether this potential can become real growth, real profits, is something that we need time to tell us. And what is certain in that case is that we certainly need time to sink in before we can see any sort of results, to see if this prophecy is going to become the reality. So its valuation is of course the tech valuation, which means it has a limited relevance to reality or fundamentals, but a lot more to dreams, to our desire to see the stock going higher. The key factor that's going to influence the success, in my opinion, would be what I call the speculation on speculations. Our speculation on other people's speculations about this stock. So the recent price action suggests that the price is bottoming and has bottomed over the past few weeks. The market doesn't want to send it lower in the short to medium term. And why is that, you might ask? It's probably because the current factors that are very few of which are positive, by the way, but the current factors have been priced in. So a high oil price, potential economic recessions, instabilities in the world, so on and so forth. So these things have been priced in. This is why the market has stabilized to a new normal, which could be further destabilized if it's spooked by other developments over the next few months and years. So the reason why the market has stabilized itself and probably bottomed is that things that caused the sell-off to begin with have now been priced in. So we're now in a different phase in this overall bearish or grinding to lower levels type of thing. The other influential factors might include the interest rates from the Federal Exchange and, to a limited extent, its own fundamentals. How long can this company start generating net profit? They can give us a date, but I think that it's going to be a matter of years in plural form. So it's going to take years before this company can start generating cash flows on its own if things go right. And if things don't go the way they wish they would go, we might have to have a little bit more patience, or we might just dump the position, right? And in the meantime, is it possible that the stock will continue to dilute the shareholders in order to keep cash coming in? This is also a real possibility. And if anything, I would say that the main reason why tech stocks over the long term, so over 5 to 10 years, the reason why their stock price could start going lower and lower and lower is not necessarily because its operations are going sour. Of course, not yielding a profit is not necessarily great either, but it's not like some scandal is boiling, right? What it often means is that as time goes on, they may run out of cash. And one of the easiest way for companies to raise capital without really promising that much, meaning, if you borrow money in the form of debt, you have to reimburse that debt. Otherwise, it would be insolvent. The company could be liquidated. But if you issue stocks and people buy those stocks, they would be essentially trying to see if they can get their money back. Even if the company declares bankruptcy for whatever reason, they don't have give back this pot of money, right? So this is the big appeal of diluting the shareholders. Of course, the downside is the company is happy, but not really its owners, because the owners would just own less of the same company. So that is like something that they would have to play with over the next month and years. And of course, they can also decide to take on debt if the debt level is considered, tolerable or manageable. So what kind of investors would this company really be for? In my opinion, it's going to be the people who are very risk-taking, very risk-tolerant, and have capital to spare. And I want to emphasize on spare here. This is not really a time to start going heavy in growth stocks. I know that the sell-off, like the initial phase of the sell-off already happened, but I highly doubt that this is the end of it. I think that we're going to see more of the sell-off over the next few months and even years. So this is why we need to have capital ready for that moment to occur. And of course, it doesn't need to sit in your checking account, or it doesn't have to sit into a savings account. There are better options out there in order to earn some money by lending it or by putting it into some safer investment vehicles and wait for the market to return. Now, speaking of the bottom, because we talked about it before, right? We mentioned it earlier in our video. Some people may believe that now is the bottom. I don't think so, but I think that the market would get more reluctant before sending the stock to even lower levels for some companies. Now, if we look at MTTR, if things go on like this, can the company remain in the NASDAQ, right? This could be a question to be asked at some point. So the management would be incentivized to not let that happen, to not let the delisting happen, to remain in the public exchange so that institutional owners can have the flexibility or the possibility even to own some. Because once a company goes to the OTC market, over the counter, or sometimes we call them the pink sheet market, a lot of institutional, institutions handling money or managing funds, usually they wouldn't allow their funds to be invested in OTC market. And this is why, like recently, I remember, I think it was Evofem, and we're also going to do a video on Evofem as well. Evofem was delisted from NASDAQ to the OTC, and then its institutional owners instantly dumped it. The ownership, like the institutional ownership, went from something like 60% to 11% overnight. I haven't checked how things are going right now, or if they're thinking about going back to NASDAQ, but I'm just saying, like, this kind of thing doesn't sit very well with institutional managers. So, you know, this is something that we have to look at over the next few months. And of course, keep in mind that when the market is getting desperate, or when the market doesn't look very well, this is when people should start thinking about buying in. This is a typical rule that we must follow, not only because it protects our downsides, but also because it makes sure that your capital gets in at the right moment and gets out at the right moment as well. Now, obviously, it's easier said than done, right? Nobody could have predicted that the current bullish phase run almost on, printed bills for more than a decade. So this in by itself is kind of incredible. But I think that the market is now moving towards something new, and that over the next few years, it has to determine, like, based on which factors we can collectively hope for a new bullish phase. And if so, when? I think that it's going to take years, during which time MTTR can continue to develop its operations, to deliver more products, and maybe to prove to the shareholders that it has the capacity to survive on its own, without having the shareholders continue to dump money in. So, like I said before, over the next few weeks, so the short and medium term, I don't think that MTTR could go lower still, right? It's going to have a pause in that phase and then try to edge higher. But this is trend dependent. This is macro trend dependent. The company's own fundamentals, as well as the predictions, unless they spook the market, and I would say unless they really spook the market in the wrong way, it's not going to move the price by that much. If the interest rates go up or down, that is a big one. Same goes for negotiations surrounding, instabilities around the world. This as well can have a major impact on the stock market at large, and in this case, to MTTR in particular as well. So I would say that if you want to buy in MTTR, now could be one of the entry points, because we have seen with some degree of certitude that we're not going to go lower, right? And the marginal position should be limited to something that you can afford to spare and to lose. For example, SoFi recently went down significantly. My position in SoFi went down by 50%, but it didn't affect my portfolio in any way, shape, or form. Meaning, compared to the total P&L of my portfolio, it's peanuts. So this is the kind of thing that you have to keep in the back of your head, because when things get better, you would need to have more capital to follow in by then. So make sure that one, whatever you put in now is what you can spare, and two, don't go in all at once. Like even that small allocation, don't go in at once. Spread it over the next, 3 to 6 months, to say the least, and see from here where things go. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.